So one of the questions we care about is, what difference does microcredit make? And one of the concerns that people have talked about a lot in the last few years is microenterprises and why they don't grow. A lot of that is focused on the microenterprises themselves, but it's possible that it's actually about what's being delivered to those microenterprises. So you and Erica Field conducted an experiment to look at that. Could you tell us some about that?
Sure. So as you said, when we started thinking about the needs of microfinance clients, and we were working in Calcutta, where pretty much every microfinance client is a micro entrepreneur, typically doing some kind of small scale vending business or selling saris or tailoring. It was clear that they need the credit to run their business, but it also seemed like they had some flexibility in how they could use the money. And when we talked to them some more, their response always was that how they use the money really depended on the form in which they got it. And then when we went back and started talking to the MFI, we realized that from the perspective of the microfinance institution, they think a lot about repayment when they think about lending to the poor. So their biggest concern is to not have default, to have a high repayment rate, because that determines their credit rating, which determines their access to capital in the near future. And so as long as the client is paying back on time and they have high repayment, they don't actually think very much about what the client, on the other hand, spends a lot of time thinking about is how exactly to use the money. So the more we talked to the clients, the more it seemed like the trade-off they faced was that if they had to start repaying very soon after they got their loan, they felt it was too risky to put the money in anything other than working capital. So they would typically use the cash they got to do a little bit of stock up, but essentially not just keep aside the first or second payment back, which was typically 2 weeks after they got their loan, but be extremely conservative in how they used it. But when we talked to them and asked them, what they thought about the prospects of their business, they certainly were willing to be very ambitious and talk about things ranging from how they would like to experiment with different varieties of goods they sold to actually going further afield and trying to get more clients. So given that we went back to the MFI and tried to talk to them about thinking about a more flexible contract form where they actually started by giving clients a grace period. The MFI was certainly a bit hesitant to go down this route. They felt that this would increase their risk, so we agreed with them that we would actually write a contract where we would cover their risk if default increased. And the second constraint that we faced was regulatory, that microfinance laws by regulation can't exceed a year, otherwise they sort of enter differently on the books of the MFI. So given that the classic contract was 44 weeks, the maximum we could extend it to was 52 weeks. And so that in some sense defined for us the grace period we could introduce, which was 8 weeks. So given these constraints, we then ran a field experiment where a random set of client groups, which were typically on the second loan cycle, were given 8 weeks before they had to repay, but once they started repaying, they repaid at the same regular frequency, which in this case was every 2 weeks. We collected a first bit of data at the end of the loan cycle, which really just asked them what they used the data on, and there we saw increased spending on businesses, but I'd say everyone was spending on their business. So it looked they were spending more, it looked like they were spending more on raw materials and inventory, but we couldn't see very strong patterns. We went back 3 years later and re-interviewed the clients, and I guess the advantage of working in a large Indian city is that people actually don't migrate out that much. It's not like the US where you see a lot of mobility. So we could track close to 90% of these clients, and at that point we see huge differences. So we basically see that the clients that had a grace period loan were essentially over the next 3 years seeing returns to capital of between 4 to 5% per month, which is what we see when we look at these sort of what we call these helicopter drop experiments where you sort of just give entrepreneurs cash.
Demal and McKinsey
exactly, Demal and McKinsey in Sri Lanka did this, but we have not been seeing this in microfinance experiments. So that sort of was the good news. So the good news is that we're seeing high returns, and it seems like the reason is that these guys are actually literally changing the nature of the investment. They're behaving much more like we would think a venture capitalist would behave. They're taking more risk, they're making bigger investments. The downside, of course, is with risk comes default. So at the same time as we see this high return, we also saw default go up 3 times. So in our control group, or the group that got the classic contract, it was 2%, and I think went up to 8% in the group that got the grace period. So, one question this raises from a policy perspective is, we know now that at least in this population, there were reasonably high returns to capital. These were returns to capital that are very comparable to what Demel, McKinsey and Woodruff found in South Asia as well. But is this something that actually is actionable through a profitable MFI contract? So you can imagine the one way you could do it is say, well, a microfinance organization should then offer 2 contracts. One is a very inflexible, lower interest rate contract, and then this more flexible sort of grace period style contract at a higher interest rate. And then the question that raises is, well, if you offer these 2 contracts and you ask clients to self-select into it, what are the kind of adverse selection or model hazard problems you might see? Will you start seeing either clients now undertaking too risky activity, or the more risky type clients who MFIs don't want coming in? And so we did a set of calibrations to look at that, and it does unfortunately look like the case that it's not obvious the market can sustain this sort of high risk, high return contract at a higher interest rate. So I think where that brings us back from sort of a policy perspective is to say, what we've learned in this experiment, we think, is that there are returns out there, there are risky investments that are high return, but in order to realize them, you're either going to need much better screening mechanisms, so much better credit bureaus and such like that actually let MFIs identify what's the level of risk a client is going to possibly come with, or alternatively you need subsidies. You need the government to step in and say, fine, I know this is going to be 8% default, but I'm going to subsidize. And I think the thing to remember here is that if we look at sort of small business contracts or loans in the US, we know that there's both subsidies and default rates are between 10 to 15%. So it's not impossible to imagine a world where you say that if you want to actually encourage these activities, we have to give up a little bit on this idea of this microfinance contract being the one that's always profitable, but be willing to think a bit more potentially about subsidies.
I mean, it's strange you bring that up, that this is a market failure in the United States, right?
Yeah.
Small businesses have a hard time accessing growth capital.
Exactly.
No one ever thought that banks would be a good source of growth capital for small businesses. Why did we ever think that banks would be good sources of growth capital for microenterprises? Is it just we weren't thinking about it the right way, or was there a reason to think that the markets operated that differently?
I mean, I could throw the question back to you. I mean, I think it's an interesting question. It's also to ask that maybe in some sense, we got greedy. We started by asking the question of, can we ever lend to the poor and not have 40% default rates, which was, I think, a lot of the norm before microfinance came along. Microfinance gave us an opportunity to show how it's feasible, and I think we have evidence to say that the basic microfinance product, for instance, does achieve some amount of consumption smoothing. And maybe we should have just stopped there and said that fine, it's like credit card debt. That's what microfinance is going to do. But then we also decided we want to also see high growth. Right. And if we don't see high growth, we said we're going to infer something about the ability of the poor. Mm-hmm. And at every step, I think we were building in more and more assumptions.
And so, how do you think now about that question about ability to poor? Because there is a lot of research that says, well, maybe there's some missing capital, not the financial capital, but human capital or management capital of understanding how to grow. There's this theory that lots of microenterprises don't grow because the people don't want them to grow. Yeah. They're not really interested in being entrepreneurs. And then we have these results, but when they do get financial capital, they can grow, or they can at least get high returns to capital. So where do you think the balance of evidence on that is right now?
So I think, in some sense, all good things are good. So certainly a lot of investments can be complementary. You can imagine having high growth rates for some segment of the population without business training, without management training, while for other segments of the population that might be something that's valuable. I do think what is the case that we had a bit of this confusion between the returns to capital that were showing up, not just, as I said, from these kind of cash drop experiments, but also when we looked even just slightly higher up at sort of small sector enterprises of high returns, and just seeing no returns to microfinance. And I sort of think that what we did was provide some evidence on why contractual form may have been one big constraint there. Just as when you think about, say, other aspects of business growth, people have pointed to labor market regulation. I think there's a large literature now saying that in a lot of countries, there's this missing middle which can potentially be explained by labor market regulation. And I think sort of we should return a bit to this question about financial regulation and the role of financial regulation in just affecting how we provide access to finance to the poor.